Amid signs of price pressures returning to the Canadian telecom sector, our featured guest today says there are still some positives beyond the core business concerns. Joining us now to discuss is Vince Valentini, Managing Director for Equity Research with TD Cowen. And for full disclosure on the companies covered by TD Cowen, a division of TD Securities, please see the link to the website at the end of this video. Vince, great to have you back on the program. What is going on with telecoms? It's clearly not the headline story in all the financial press right now, but there's some interesting moves.
Yeah, and always great to be here, Greg. So the stocks, have held in reasonably well this year. I think some people are a bit concerned about some of the macro and geopolitical events going on, and this is somewhat of a safe haven sort of sector. There's the odd, dusting of concern about a recession in Canada at some point, and again, these would be names you typically want to own in that type of environment. So I think that's sort of keeping the fund flow to keep these names, doing reasonably well. But underneath the surface, we're getting a little bit worried that some of that price war stuff that we saw for pretty much 2 years straight, from the middle of 2023 till early 2025, all of which, as you recall, came after Rogers acquired Shaw and was forced to sell their wireless business to Quebecor. That's when things started to get a bit more painful for the industry. It seems to be coming back. The past 2 months even have seen much more aggressive pricing competition than we're used to seeing, especially at this time of the year when, January, February, March are typically slow seasonal months. If you're going to see the odd promotional misstep, it's going to be at back to school period or Black Friday period, not in, the middle of February when people are generally not shopping for new cell phone plans. So I would term it as we're on a bit of thin ice right now. We have, the typical end of quarter games that get played by the telcos to try to jam a last few number of subscribers in that they can report when they report to us analysts in 5 or 6 weeks. We need to see this behavior stop come April. If we continue to see what we see, and I just give you one example, and it's good for consumers if you're on the line there thinking of the consumer side of telecom versus the investment side, go out and shop for a new wireless plan. Virtually every Rogers, Bell, and Telus store right now has at least $35 for 100 gigs of data. That typically should be $55 or $60. And there's even been sporadic sort of promos at $27.50 for 60 or 80 gigs of data. And a lot of times they're throwing in US and Mexico roaming into these plans. This is dramatically lower than where the price points need to be to get revenue stabilization for these companies. And it creates the risk that the quote-unquote disruptor in the space, which is Quebecor and their Freedom Mobile brand, who actually are not the lowest priced offer out there right now if you went to any mall and looked at the stores, they may fire their own shot back. I think they'll give the carriers through the end of this quarter to see the sort of end of quarter games, but if we're sitting here in the second week of April and the telcos, the big three telcos, have not gotten more disciplined with their pricing, I would think Quebecor will escalate this price war even more. So I'd say the core business is on pretty thin ice right now, unfortunately. We need to see behavior turn quick, or else the investment community, I think, is going to get more concerned. On top of the pricing is the more important dynamic and the one that's changing. You obviously still have a backdrop of no real population growth. In fact, StatsCan data show we actually had negative population growth in the fourth quarter for the first time in a long, long time. So if you have no population growth driving the volume side of the equation, you're even more desperate to have stabilization in the price side of the equation. So core wireless fundamentals a bit challenged, as you said in your opening, which means we have to kind of pivot and look for other ways to try to make money on these stocks.
Let's talk about the other ways, because each company, as you were pointing out to us before we got on the show, has its own unique, everyone's got the core telecom business, and then they have a little something else that investors can hone in on. Maybe we'll take them company by company. Rogers.
Yeah, and Rogers, I think, is probably the biggest in terms of that because of their sports file. And they've had material interest in sports teams for over a decade, but it's become much bigger as a percentage of their market cap and enterprise value, and it's become much more relevant to us analysts and the investors because they're articulating a path to finally monetizing some of the teams and showcasing what the value is. It's tough to showcase the value when the only person who's bought these teams in the past has been Rogers. It's their own money going in to buy, the stake from BCE a couple of years ago, and their own money going up to buy Larry Tannenbaum's 25% stake, which is a deal we expect to happen later this year. You need a proof point from a third party coming in and saying, yes, we agree with Rogers. This collection of teams, which is one of the biggest, most attractive collection of sports teams in North America, as a reminder, Leafs, Raptors, and Blue Jays being the three core tenants, but they own other properties as well. That combined asset mix is worth, in the range of $20 billion. But you need third-party capital to come in and give sort of verification of that. It seems likely, according to what management is saying, and our own analysis would back it up, that we will get that transaction sometime in 2026. Probably not till the fourth quarter. They have to deal with buying out Larry Tannenbaum's 25% stake first, which is a process that's going to run from July till September. Once they get that cleaned up, then they will immediately turn their attention to finalizing a deal with a consortium of wealthy individuals, private equity firms, and sell a stake. So that is still a path, and we've published a lot on this recently, a path to value creation for Rogers shareholders that's not fully or properly reflected in the share price yet. Not that far off if it's happening this year. To be clear, we do expect a second transaction we've published on, but that's not happening this year. May not even happen in 2027. It could be a 2028 event where we see full separation of Rogers into a cable, wireless focused entity, and then all of the sports, entertainment, and media assets in a different publicly traded vehicle, which we think is the best solution for the long-term value, because investors have a really tough time saying, how do we value a baseball team or a hockey team that doesn't generate any cash flow when it's buried within a boring, low growth, but cash generative cable and wireless business. So you need to have these things separate so investors can value them properly. So we'd see that as the ultimate end game. So Rogers for sure tops the list, Greg, of companies that have something they can offer as upside to shareholders, even if you're a bit concerned about that core wireless business not having much growth in the near term.
Well, let's get to the other big player, one of the other big players in the space, BCE. What do they have to offer beyond the core business?
I'd say it's still pretty big for them. It's not so much of a catalyst of a hidden asset that people can't value properly today that will explode once a transaction happens, the way you kind of have with Rogers in the sports. But if you add up all of their quote-unquote non-core telecom stuff, you have their Ziply business in the US, which was their $7 billion acquisition just about 2 years ago. It's still a telecom business, but it has no exposure to the Canadian market and the Canadian price war in wireless that may be starting to happen again. And the fiber business in the US is showing good signs of steady progress. As you build fiber, it's the better technology, you generally win market share. So that's a good sort of mid-teens revenue and EBITDA growth business for them that's differentiated. And then they have data centers, which again is still has the tenets of a telecom business. You invest CapEx, then once you own that infrastructure, you get recurring cash flow for many years to come. So it's not that much different than building a fiber or wireless network, but obviously a bit nuanced that it's serving big enterprise customers and serving AI capabilities and AI compute. And Bell has been somewhat hitting the cover off the ball on that strategy. It only started about a year ago when they first started talking about it. They had their first facility up and running in Q2 of last year, which was already fully pre-sold, and they got some nice revenue from it. They gave some nice targets at their investor day in October as to what they're going to do with this business over the next 3 years. Those targets were to do 73 megawatts of computing power across 6 or 7 data centers in Canada over the course of 3 years. Just a little over a week ago, they announced one facility in Saskatchewan, already fully powered, already fully partnered with in terms of customers and government relationships that are necessary to build it. 300 megawatts of capacity in one facility. So they're blowing through their targets that they had set. So it's starting to become a bigger business for them. I don't want to overplay it. Even at really good success, it's maybe $1 billion of EBITDA for Bell a few years down the road. So it's still sort of 10% of what the total company does. So it's not going to become a pure play data center AI processing company, but that's a nice adjunct to the core wireless and wireline business that you get a bit of differentiation with BC as well.